The FOMC meeting takes place this week, and it is expected that the chair, Janet Yellen and co, will keep the benchmark interest rate on hold, with Fed fund futures highlighting a greater than 90% probability for the move in December. So everyone's looking to December now. But this meeting, it still has significance. It's a big week. Well, James Bevan from CCLA here to explain exactly why. I just said we're not expecting anything this time round.
Quite right.
But we're expecting the tone to be set for December, right?
Absolutely. The market is absolutely expecting there to be a hike in December. It's as strong a probability as one gets in central banking circles. But of course, the real focus of the market is also who will be in charge of the Federal Reserve next February when Mrs. Yellen steps down.
And who do you think it will be?
Well, we believe there are really now only three candidates in the offering. There is Jerome Powell, who is an incumbent at the Federal Reserve and is widely seen as a so-called dove, in other words, one who likes relatively easy monetary policy. The other end of the scale, there is Professor Taylor. Now, he is a Stanford economist, and it is known that he would like much higher interest rates, a much tougher mechanistic policy. And then there is, of course, Mrs. Yellen as the incumbent. Now, Mr. Trump has been tweeting, as always, about these things, and it's reasonably clear he would like to be able to make his mark, which suggests that Mrs. Yellen will not be reappointed, which is unusual because normally federal bank chairs do get a second term. That suggests, from the market's point of view, the odds-on favourite is Jerome Powell, at least from the sense of consistency.
OK, and what does that mean?
That we should have relatively accommodative monetary policy. That would be well received by markets, and therefore, if he is announced, I would expect the markets to go better.
OK, and she said over the weekend that the biggest sticking point for her, or the biggest mystery, she put it, was inflation. It's an issue.
I don't think she shops with Amazon. Anyone who shops at Amazon will know where disinflation is coming from. The disruptive companies that are cutting prices and not necessarily pursuing profits. So after all, Amazon's numbers last week demonstrated a huge rise in turnover, but a remarkably small shift in profit. Most of the profit coming from their web services, not from their sales. So the consumer benefits, inflation remains extremely low, but at the same time, it's very clear that profits growth is not top of the agenda for Amazon.
OK, and while we're talking about US data, this week we've got the jobs number on Friday, and because of the disappointing number last time, we're expecting a bumper one this time.
Well, do you know, everyone says that jobs numbers can only go one way. When one has unemployment this low and still with no wage inflation, I begin to anticipate that we are dealing far more with a challenge of too much debt in the economy, which is one of the reasons why very low interest rates have not worked. So I think that the market will become less obsessed with jobs numbers and more interested in terms of the outlook for the bond market. And perverse as it may be, when the Federal Reserve does hike rates, we might see the long bond yield actually fall as people begin to anticipate that the economy will slow.
OK, and just going back to the FOMC meeting, so nothing on the agenda for this time, setting the tone for December. But the markets are going to do something, surely? Are we going to have any movements at all? What should we anticipate?
Well, the market at the moment is attempting to trade off increases in corporate earnings relative to the price that should reasonably be paid to participate in that profit stream. And we've had quite a lot of the third quarter numbers now out.
Which were brilliant.
They've been good. They've not been as good as some people had expected. So people are beginning to say, do I really want to pay 18 times forward earnings to participate in the story? And therefore the valuation challenge is becoming more acute. That said, I do think that if monetary policy remains easy, we have far more risk of a so-called melt up, where valuations shift up to say 20 times without any significant move up in corporate earnings, at which point we have a genuine bubble, and then we're ripe for a material correction.
OK, and we've got Facebook this week as well.
Yes, we do. Isn't that an interesting conundrum? How does Facebook really make lots of money over the long run? And it was very clear last week that we were beginning to see a bifurcation between Microsoft and Alphabet making enormous amounts of money, and Twitter announcing that it hadn't yet made a profit, but it was hopeful that the next set of quarterly results would produce the first profit ever.
And they're also speaking this week about meddling in the Russian situation with the election in 2016, those companies. So that's something to watch too.
Yes, and one does anticipate Mr. Trump is not that friendly to Silicon Valley. And one of the big risks for the market is at some point he goes for a so-called antitrust move, which is where he says, look, guys, you're not running this sensibly. You're running this to try and kill other businesses. We don't like it. We're going to constrain and regulate. That would be bad news.
OK. All right. Thank you very much indeed.
We'll leave it there.
That's James Bevan there from CCLA talking to us today about who will be the next head of the Fed.